Good afternoon, everybody. My name is Svetlana Buryak, and I welcome you everyone to our second webinar in the series of webinars on transfer pricing aspects of intangible assets. And I also welcome our speakers today and our moderators. So today, the topic of the second webinar is valuation of intangibles, including hard to value intangible assets. And today we have two excellent speakers and experts. Thank you so much for joining us, Kerim Keser and Sebastian Frankenberg. Kerim Keser is a managing director at the German office of Kroll's, and he's responsible for German, Austrian, and Swiss transfer pricing activities. And he has many years, if I can say 20 years, of transfer pricing practice in the tax administration and also from an advisory side. And Sebastian Frankenberg just recently joined Dentons. I can probably announce it now as head of valuation at Dentons, and congratulations on that. And Sebastian has really rich experience in valuation services, ranging from equity assets valuation and also to management, buyout, participation plans, and value-based management services. And so much. And the floor is yours.
Thank you, Svetlana. Thank you also for basically stealing half of my introduction, but that's absolutely fine. You did a good job. Welcome everybody to our first session about valuation of intangibles. It is the first one, but certainly not the last one. We are planning to organize more sessions on valuations. You may appreciate that valuation is a complex topic and it cannot be squeezed into 1.5 hour session. This should be seen as an introduction session. And during this session, our special guests, Kerim, Keser, and Sebastian Frankenberg, as introduced by Svetlana, will take us through the most important valuation aspects, specifically in the context of transfer pricing. You will also appreciate that some of the topics are so complex that cannot be fully clarified during this session. However, we will zoom into some of those sessions and the follow-up sessions. For instance, they will talk about valuation methods at a high level, but we're also planning to have a session on valuation methods, how they applied in practice and so on. So what will they do specifically? They will talk about the relevance of transfer pricing, relevance of valuation for transfer pricing purposes, and that they will also address how value can be perceived from different perspectives, including use of traditional valuation methods, but also transfer pricing methods for valuation purposes, and that from OECD transfer pricing guidelines perspective, but also from international valuation standards perspective. Furthermore, they will cover the most important factors which can drive the value of intangibles higher or somewhat lower, such as useful life or discount factors. If you have any questions during this presentation, please pose them in the chat function, and I will address them to our speakers. And with that, I would like to turn to our speakers for their presentation. I am sitting in the same room with Sebastian, so that makes it a bit hybrid event than just online. And the floor is yours, Sebastian and Kerim.
Yeah, thanks a lot, Rezan. Also, thanks to Svetlana and Ritka for inviting us. It's a pleasure to be here. And before we start, Svetlana, I believe you're going to share the slides, and we'll go through. Thanks a lot. Yeah, so it's great, and appreciate also that, Rezan, you're shaping kind of like how we structured this presentation. Valuation of intangibles, huge topic. So we will try to cover as much as possible on interesting and controversial topics for the ones who are maybe a bit more experienced in this, but also try to capture the background of when is it actually applicable, what kind of like differences do you have, whether you have any options or not, and what to consider when either doing evaluation yourself or reviewing one or assessing the appropriateness of that for your business. If you don't mind, Svetlana, then going through the agenda, we can go briefly through that. So we'll start with a brief overview of the relevance of TP-specific IP valuation. And here we thought we'll do that because the title here is Valuation of IP in a TP environment. So we'll focus on what is actually different when we're talking in valuation for TP purposes versus a general valuation. But of course, we'll capture the backgrounds. We'll talk about the valuation gap, maybe between the valuation for financial accounting purposes versus transfer pricing, traditional IP valuation aspects. Then we'll dive into transfer pricing, specific approaches, talk about how to value intangibles, and a few special considerations we prepared. If we start with the first chapter, relevance of TP-specific IP valuation. So, I mean, to state the obvious, we all know how critical IP is in a business environment. So in the recently, and we're expecting that to be the same going forward, IP will become more so a driver for business profits, and that's the core of any transfer pricing analysis we're doing in general anyway. So we'll know that the main driver of non-routine profits are usually IP. And we also know that we have an increased relevance of IP in the general scheme of things. And there's a famous study from Ocean Tomo that showed, like, if you look at the S&P 500 companies, the total value of IP within that group increased from 17% in the past to now 84%. This is like from an aggregated perspective. So it's important. It's going to be important in any case, whenever you are doing a restructuring, whenever you are specifically deciding IP should be centralized somewhere else, or you're acquiring an entity and then IP is moving from one entity to the other because that's your transfer pricing model you're implementing. The objective of this course is, again, what's the potential differences in valuing intangibles, when are IP valuation or financial reporting purposes applicable, and what adjustments may be needed, which scenarios, which alternatives can be adopted, and how to bridge that gap. And of course, what the pressure points. Limitations, just also to cover that, we are not discussing any substance requirements. We're assuming in our discussion that is fulfilled. So IP is there where it belongs. We have the right DEMPI functions. So that will be rather a different session. We don't go too much into definitions. We rather go into the analysis and how we are trying to find like a arm's length value for IP. And our examples here are very, very simplified, but we'll think that's for a presentation always the best part to start, and that gives you a better insight in the pressure points on IP valuation. So bear us with that, very simplified, but it's for presentation purposes. With that, we'll dive into the next topic, the valuation gap, and I hand over to Sebastian for that.
Yes, thank you, Kerim. Hi, all. Like Kerim pointed out, I think it's important first to set the scene a little bit when it comes to valuations in general, and then slowly works towards the specifics of transfer pricing valuations, because both of them are interrelated, obviously, to each other. And this slide, referred to as the valuation gap, can be seen as maybe one of the most important takeaways for our sessions, because it immediately shows the implications and the difficulties when we want to come up with a valuation for transfer pricing purposes that maybe need to be aligned with other valuation reports, other valuation standards, other valuation contexts. So I think it's an important one. It may sound a bit theoretical or academic when we are discussing standards and definitions. But again, I think to get a right understanding of the topic, and also this is why we have this session in the first place, right? Because there are apparently different views on value. It's important to spend a few words on this one. To start maybe with the valuation standard, so the value definition you see on the left side, the principles of fair value, fair market value. You can also add on the principle of investment value. On the other hand, the arm's length value, and just to make sure we're on the same page, referring to arm's length value rather than arm's length price. But this had nothing to do with the discussions on the difference between value and price, being the result of a negotiation when a buyer and seller would come up with their own valuation, and the actual price to be paid is referred to as the price. Here's just the arm's length value to show the difference between other value definitions and the arm's length value. If we look at the concept of fair value, it's used for financial reporting purposes, and it is freely translated something along the lines that it's the price paid in an orderly transaction between market participants at measurement day. That sounds a bit strict, and that is explicitly also the reason it's so much different than the perspective we take for a transfer pricing valuation. Because as you can hear in that definition and see that it implies you're dealing with a hypothetical market with hypothetical market participants, and therefore, in principle, does not allow or focus on any specifics relating to a transaction, which is obviously crucial in the transfer pricing analysis. So when we're dealing with specific synergies for a buyer, relative bargaining powers, legal rights, taxation benefits, all those specifics relating to transactions are in principle disregarded in the concept of fair value. Also, if you take, for example, the acquisition premium, it's a well-known concept when we're dealing with valuations, but it would not reflect any buyer-specific benefits in the fair value principle, where it can be the case for the arm's length value. And the same goes, and we will not spend too much wording and time on this part, goes for other valuation standards as for market value, which is typically used in a taxation context, so not being a pure transfer pricing setting, or the investment value. And related to that difference, I think another important gap, so to speak, is purely how you perceive value. A lot of times clients would ask me, can you just come up with the value? And it's sometimes difficult to understand, and I think important to emphasize before we dive into more technical stuff, that partly of the purpose of the valuation, it's for financial reporting purposes, is it for tax purposes, is it for arm's length purposes? There may be a different starting point. But also, if you go into more practical implicalities, for example, when you would like to price risk, I think, to give a very simplified example, the valuation context is very important. If you on one hand have, let's say, a fully and well-diversified investor, a conglomerate like GE, that is looking to acquire an asset or a business, that party would in principle only be interested to pricing the so-called systematic risk, so and not so much in the asset-specific risk or the unsystematic risk, because the latter part of risk is in principle adopted by a well-diversified portfolio. Whereas take a venture capitalist, and that would also acquire or be interested in the same asset, would have a completely different risk profile, would actually be interested also pricing as part of the total risk, also the asset-specific risk. And therefore, well, when you translate that to discount rates or other risk factors, have a completely different profile. So the point I'm trying to make here, before we go any further in this presentation, is that even before we're dealing with projections, financial statement analysis, come up with discount rates, it is so important to set the scene. Which purpose is the valuation needed for? What is the context? What is the market participant? So with that in mind, I think we can slowly work towards the methods and the TP implications. But first I hand over to Kerim for a few other aspects when it comes to the valuation gap.
Thanks, Sebastian. I think you mentioned already the purpose of the valuation, and here we promise not to talk a lot around definitions, but it's probably good to take that link and to say what does the OECD actually say, right? I mean, quite often we hear, well, we have a valuation, we have maybe a PPA, or we have a valuation for other purposes, and we have our book values in your accounts. But like if we just look at the TP guidance we have, so we have in chapter 6 of the OECD guidance, like a definition on TP for on IP for TP purposes, and there the definition already is a bit broader than what we're seeing for financial reporting purposes, where we say basically something which is not a physical asset or financial asset, and which is capable of being owned or controlled. And the use or transfer would be compensated. So very, very broad definition. And that's kind of like dissimilar to what you're doing for financial reporting purposes. And then we have another chapter, which is quite critical, which is chapter 9 regarding business restructuring. Here, although we have a definition of IP, it's the question, how do we do valuation in a business restructuring context? And that's kind of like, quite often, we'll see that later on as well, our main issues when we're dealing with this topic. And the restructuring content in chapter 9 says, well, one needs to first consider the assumption the valuation was done. Here comes the motivation argument, Sebastian, you mentioned as well. And quite often the motivation and purpose for financial reporting purposes is rather of very conservative nature, and the assumptions are also therefore very conservative. And that may lead to a definition that is too narrow for transfer pricing purposes if you're doing an IP valuation for transfer of IP purposes. So that's one element of it. And the other part of that is it may be broader. So the IP transfer may actually trigger a certain follow-up events of changes in your business organization, how you deal with your related parties, meaning not just looking at the narrow definition of IP, but quite often saying what else is changed, and therefore rather having like a bundle approach or a package deal. Quite often we use the wording profit potential. So that's going to be an important distinction. But with that, let's dive into the valuation approach from a traditional perspective, and then we'll move over to the transfer pricing specific ones.
I think maybe before you go into the next slide, and you may be addressing this already, Kerim, because you did mention OECD guidelines, chapter 6 and chapter 9. And we also know that the OECD guidelines mentions in chapter 6 that the valuation of intangibles in purchase price allocations performed for accounting purposes cannot automatically be used for transfer pricing purposes, but it leaves also the door open to be used if you kind of have a careful consideration in terms of what you need to adjust. It may be useful if you explain in the valuation approaches in what circumstances can you actually rely on purchase price allocations, and if so, what kind of adjustments you need to make.
Yeah, that's a very good point, Rezan. So you're right. Those reasons we've just mentioned, right? They're the ones that say, because the motivation is different in a PPA environment versus for transfer pricing purposes, those conditions need to be considered. And I think that's section 6155 of the OECD guidance, which refers specifically to purchase price allocations and their outcome. I'll answer your question, or together with Sebastian, in the next slides, because we have actually prepared exactly the elements, and then we'll dive into that a bit deeper.
Yeah. And yeah, let's touch upon that in a minute, Rezan, but that's a good question. Maybe to make sure that we're all on the same page going forward, because we notice there's a very mixed audience with different backgrounds. When we're addressing the concept of PPA, we're speaking of a so-called purchase price allocation that is typically prepared for indeed financial reporting services after an acquisition, to actually break down the acquisition price into various assets, both tangible, intangible assets, and the remainder are typically classified as goodwill of that purchase price. But we'll come back to that in a minute. Just before we get into the TP specifics, I think it would be very helpful to quickly go over the main valuation approaches, and they are used also for financial reporting purposes or tax purposes, but also for transfer pricing purposes. So a good understanding, at least on a high level basis at this webinar, is, I think, important. As you can see in this slide, the main commentary approaches are referred to as the cost approach, the market approach, and the income approach. They have a lot of deviations and moderations to it, but quickly addressing the main specific of those approaches. And for the income approach, I will dive a bit deeper into the methodology, because Simply put, it's the preferred method for many practitioners, and actually also for the, as mentioned in the guidelines, when it comes to income generating assets. So a bit more wording on that part. The cost approach, yeah, that is the approach that you don't see that often in practice. For certain assets, it's actually very helpful, or maybe even the only way to go forward when you want to put a value to it. For example, when it comes to assets that are not yet commercialized, like assembled workforce or internally developed software and databases. And it refers to the cost of replacing it with a comparable asset, or to reproduce it with an asset that has the same utility. And so you already see two different variations: the reproduction cost method, that is based on the cost incurred to reproduce or create an identical asset, and the replacement cost method, well, focuses on the costs that are needed to acquire comparable assets with similar, virtually similar utilities, such as a CRM system or other similar assets. Although it sounds a bit basic, it's actually more difficult in certain circumstances than one might think. That has to do on one side, because it's a careful assessment is needed on the cost base, right? What to include in the cost base. In the end, all costs that are related to the asset should be included, but it also has to do with the attitude of the market participant in question. What his attitude is when it comes to cost. For example, are we dealing with early stage development costs or overhead expenses, cost-related risk factors such as high or unexpected expenditures. So the attitude of that market participant can obviously change among those participants. So that is an important one to keep in the back of your mind. When I mention all costs should in principle be included, it means direct costs like materials and personnel costs, but also indirect costs, obviously. And when you would focus on what type of indirect costs, then obviously you focus on overhead costs or IT infrastructure costs. But the interesting element here when you're dealing with indirect costs is also whether or not to include opportunity cost or maybe a profit margin if needed. So a lot of analysis goes actually into the way to set up and make an overview of all the costs that were actually needed to reproduce or replace that asset. In principle, the OECD guidelines explicitly advise against using the cost methods, having some reservations with respect to the arm's length principle in terms of comparability. And I think to a certain point that is a valid observation. But like I said before, in certain circumstances, I guess it's the only way forward, or at least can be used in connection with other methods. As a final remark on the cost approach, it's an element that is sometimes not included in the cost approach valuation analysis, is to keep an eye on so-called obsolescence charges. So meaning that certain expenses that were incurred at the time when developing the subject asset may nowadays be obsolete because, for example, given changes in the technology over time. And the way to reflect that in your cost approach valuation analysis would then basically be to perform an obsolescence charge, so lowering the value, and that can be a charge for functional obsolescence, physical obsolescence, economic obsolescence. So keep in mind that technology may have changed and that not all the costs that were initially incurred may be relevant at valuation date. The market approach, I think for most transfer pricing practitioners is an approach they have a lot of feeling with, given the direct connection with the market and market prices. It's reference to pricing of comparable assets in the market, and it's based on the law of one price. So meaning based on on the principle that comparable assets are typically exchanged at comparable market prices. It's also referred sometimes as relative valuation because it's basically the value relative to its peer group of comparable assets. And you could divide the two methods, or the market approach, into two methods, being the direct method and the indirect method. The direct method, as you can imagine, is very difficult to apply because you would look for identical assets in the markets and take that as a reference price. And again, as you can imagine, those are not often observable or not frequently traded or not recent observable. You do see them in very specific scenarios, for example, dealing with governmental licenses, such as liquor licenses. Taxi licenses is like a typical example, but I never came across a taxi license valuation project or water rights. So it is possible to use them, but very difficult. And as you can imagine, hardly impossible to use, almost impossible to use when it comes to intangible assets, given their typically unique nature. The indirect method, that is basically what we all know as a multiples approach, is maybe more often used. I think a multiple approach is very well known when it comes to company valuations, in which you apply a certain financial metric to come up with your enterprise value, such as EBITDA to enterprise value or price per earning. So you have different metrics there, and the same methodology you could use, for example, in IP valuations, but then you would then base your multiple on a so-called standardized unit of comparison. So to give an example, if you're dealing with a distribution license, you, for example, could look at market data, if there's market data on number of customers for a comparable license in the market, and then come up in that case with a price to customers. So it takes into account the same methodology, but in my view, that it's difficult to apply. But in a broader sense, I would like to say that the market approach is very well attached to other income approaches, which we are probably much more familiar with, because in many cases we actually need market data. The relief on royalty method, for example, needs a royalty rate that has to be derived from market data, but also other valuations techniques that rely on the so-called discounted cash flow model need market input to build their model. So we get to that in a minute. And that is the income approach, which is also by in the guidelines referred to as the preferred method when it comes to assets and intangible assets. In this case, that generate income, so to say. It deals with future earnings capacity of the valuation object and focuses on the projected future cash flows that are generated by an asset over its useful life. And then the sum of those discounted projected cash flows would then approximate the net present value of the asset at valuation date. And I think both tax authorities as taxpayers and advisors, they really like the income approach, although there are many pitfalls to it, let's put it like that, because it's much more focused on the future, on future earnings capacity, and is not looking back at an accounting method. It's not focusing on arbitrary cost to be included, and needless to say, is a better alternative than just look for comparable assets in the market. I listed here very briefly, but if we have time left at the end of the presentation, the so-called real options approach, I think it's a very interesting and relevant method, especially when dealing with intangibles. Just to put it 1 or 2 words on it, it focuses on so-called management flexibility. So management for company or for owner of assets, you have the so-called flexibility to make certain business decisions. So you can choose to expand your operations. You can choose maybe to abandon a certain project or maybe delay a project in the first year and then resume it in the next year. All those business decisions, they imply a certain value, an option value, and that can be added to maybe your initial DCF-based valuation. A bit technical at first sight, but I think very relevant for intangibles. And as you can imagine, when we're dealing with development of a drug patent, a patent for development of a drug, and you have all these clinical stages in which you reassess whether to resume if it's a successful phase, clinical phase, or abandon the project. That flexibility embeds a certain value, and I think it's important also to capture that in evaluation.
Sebastian, before you move on, maybe just one comment. I think you made a valid point that we have this guidance or commentary that the cost approach is not the preferred approach. There's some loose wording in the OCG guidance. Just to give like maybe the insight, what the reason for that statement is. And usually there's a fear that IP, or there's the assumption IP is always of a lot of value, right? And if you just look at the cost, which means your input, that doesn't capture the real value, and therefore tax authorities quite often are concerned then that they're missing out if you're not valuing that additional value. So you're basically cutting short quite a lot. But it is valid, because if we're having a, let's say, realistic options available thinking, and actually we have an IP that is not as dramatically value adding, that is something you can reproduce, as you're writing here in your slide deck, then your alternative might be, right? It's just something I could either make or buy, and therefore the replacement cost or reproduction cost may be quite feasible here as well, but it depends on really the character of your IP you're trying to value. So just as a hint, just because the OECD makes such statements, I think there's a room for it.
Yeah, absolutely. And I would even go maybe one step further, and probably some in the audience would debate me on this argument, but in a certain way, you could say that the cost approach is maybe the best approach, or most perfect approach to value an asset, because in the end, it's based on the premise that a rational and prudent investor would not pay more for an asset than the cost of reproducing or replacing it with an identical asset. So from a more academic point of view, I think it's if it's were without its pitfalls, the reasoning behind it, I actually think it's very fair and closely linked to what a third party also would do.
Maybe one thing that we should add to that, because I think this is very relevant discussion, and Sebastian, I agree with you that if you're a rational investor, you would say, why would I buy something that I could just also make myself, or make an investment into to making it myself. Interestingly, if you look at the definition of what an intangible is according to the transfer pricing guidelines, exclusivity is not a fundamental part of it. And I've always found that strange, because at the end of the day, exclusivity creates scarcity. If I can use something exclusively, like a patent or whatever, and someone else is not allowed to do that, then I can have a difficulty in just rebuilding it, because I'm not allowed to. So, and interestingly, it's never been actually debated in the whole transfer pricing arena to which extent it is logical that you use a more an income approach versus a cost approach, and to which extent that is linked to the question of exclusivity and a sort of even artificial scarcity, because exclusivity creates a artificial scarcity. I don't expect any answer. Maybe you have some ideas, Sebastian or Kerim, about it, but I think we should place that also in the context, the discussion in the context of exclusivity.
Yeah, so Rutger, I couldn't agree more. So this is definitely an item. The way how we address it usually is, I think it loops back into the value of the IP itself. So because there we are, although we have these statements, we are at the end doing the economic analysis, and then we have to conclude, what's the value? So I think we can always take the exclusivity based on the facts of the case you're analyzing, and then say, well, this is a high value or not, and then default to a different TP method. I don't like those kind of definitions that kind of like may put you on a wrong path, but I think that's the way to resolve it. At the end, the value will be determined by it. I totally agree with you.
And there's one additional thing I would say is that taking cost approach, strangely enough, in the market, people tend to be lazy persons. We are lazy species, and although I could also bake my own bread, I don't, and it might even be cheaper, but I don't. And that is another thing in the market. Things happen, paying things for things that you could have done or made better yourself, but maybe there are good reasons to say, well, I don't want it. That is in the market at least what happens, and that is the nuance maybe also to the cost approach.
Yeah.
Very well. Just being mindful of time, also to make sure we have covered all the slides. I do have a question coming from the audience, but also one that I was curious about it myself, more on the cost method. When Sebastian has explained it very well, that there is also an element of obsolescence charge or cost, and that's what we see in practice very often when we value, say, a service that is about to become an asset or an asset itself. My question, and that is, wouldn't it be easier to use a transfer pricing method like a service charge, so they do the cost plus instead of evaluating the as an IP based on cost method, so that you reduce the controversy around it?
There was a background. I couldn't get the question really, but I hear out, Rezan, you're asking, instead of valuing an IP, whether you can actually use a service approach in terms of compensating for the R&D activities. Is this where you're going? I couldn't get.
Yeah, exactly. I recently had a case myself where the client was arguing, well, we have spent all this cost, but they don't have any value. You know, there can be different views about that. If you discuss it with tax authorities, it's always easier to argue after the fact. But yeah, you know,
yeah, so,
if tax authorities have a different view about it, but it might be easier to use the transfer pricing method like cost plus approach, and then, you know, avoid that discussion. That was my question.
Okay, good. So you're touching on, and Sebastian, I'll go first. I'll give you a chance. So the complexity here in your question would be, it goes back probably to who is in charge of the R&D and who has the main DEMPI activities and takes the risk for these. So if the risk is with someone else, then you can do like a cost plus approach and basically offload your costs to the entity that is actually carrying that IP risk, and then whether it's of value or not, they should be carrying it, but the function should be attached to the risk owner of any R&D activities. So I think that angle would be part of that discussion, and we are not really that free in who's the owner, because we have to have the substance behind, and that might impact your conclusion on this. Sebastian, any comments?
No, I agree, Kerim. Maybe more like a general comment, that the cost approach as presented here would also be applicable for other purposes than transfer pricing purposes. But it touches upon the topic we are going to discuss next, that if, for example, there is already a cost approach valuation analysis available or prepared by another advisor, whether you can use it for transfer pricing purpose. So that touches upon the topic of closing the gap. And I think one of the topics on the cost approach would indeed maybe to change your starting point on how to remunerate and take that position, as you mentioned, Rezan. But that goes, I think, for all the methods here. And I take the opportunity then also to come back to your earlier question, Rezan, on the application of PPA, because all the methods here listed here, and also later on when we're dealing with the income approach, they're all methods that you can rely on in the first place when you're assessing, for example, a PPA assessment. But referring back again to the slide with the valuation gap, because it's prepared for different purposes, certain adjustments may be needed. And I emphasize may, because I think it's fair to say that in a lot of circumstances, it is actually pretty okay. And you only need very minor changes maybe to align the value of your intangible, even if it was prepared based on the cost approach, but it goes for all methods, with the value that was calculated under a purchase price allocation. But the reason the OECD is so heavily addressing the part that it should only be a starting point, and you cannot just rely on it for 100%, is the fact that in other cases there may be actually quite a big differences, getting back to the different elements of value that are are not captured within the value definition.
There we to continue on that, Sebastian, there's a question from the audience which I think you sort of answered, but I think it's nevertheless it's good to have a slight comment by you on that. Is would you recommend only using one method or all of those that can be reliably applied? So
I think that's
you answered sort of the question that. But
no, I like the question for multiple reasons, and it's a good question because you also on this part, I think you can take different views, and the convenient thing for valuations is that it's very subjective and there's no right answer. But one could say, and then it goes a bit back to the transfer pricing practice, if you have like an appropriate method or a best method in the US. But if I take like a valuation approach, being a business valuator myself, I really like to combine multiple methods, given their strengths and their weaknesses, and especially to use them, for example, as a sanity check. To give you an example, when we are in a minute discussing the income-based approach, that is, again, I think most commonly used approach to value assets and enterprises, it is very heavily relying on subjective assumptions with regard to outlook, growth rates, discount rates, all those elements. And if you don't be careful and don't perform, for example, a sensitivity check at the end, I think it's very valuable to then look if we can see if there is a market approach we can back the evaluation with, looking for a multiple analysis. It's, I think, a bit more complicated with the cost approach, because in my view, it's an analysis in itself. But long story short, Rutger, definitely I would recommend it, and it makes also for tax authorities and tax inspectors your valuation analysis so much stronger.
And then there is, so thank you for that. Then there's another question. You already touched upon the cost approach. Would you include a markup here in the cost approach for, well, risks taken or whatever?
Kerim, you want to tackle this one, or should I?
So that question, just reading it in parallel as well. So if we're not talking about a service, we're talking actually IP has been developed or they've tried to develop something of value, and then we want to transfer that. So you want to know the IP value, and we're deciding this is IP of the characteristic that a cost approach is appropriate. Let's start with that premise. In that case, I have to look from a buyer's perspective. Actually, I would, if we do it right, we'll look from the buyer's perspective and say, what is my cost to reproduce this IP? And that's the maximum I would be willing to pay. Because the cost approach from the seller's perspective, they've already invested, and
yes,
it may not be as valuable, but I actually look rather from a buyer's perspective.
So basically what you say, Kerim, is from a seller's perspective, the costs are sunk costs. I mean, exactly. I spent them, and right. Whatever it, I mean, that doesn't tell me anything about the future value. It is just, but having said that, Kerim, one of the things I would say is if you have a cost approach and looking that from the perspective of the options realistically available, then it's like building a home or building a house. There is risk involved in the construction, and so to that extent, I would say if the sunk cost is cost in the past, but future cost is a cost that, well, you have rising prices, you have people falling out, and I thought I have the best engineer in the world who could buy me, who could build me this great artificial intelligence tool, but all of a sudden he dies, and now I don't have the engineer anymore, and that is all a risk that is in the future. So I would say the answer would say yes, you should include a certain element of. If that's,
and here we have a probably definition issue, right? Let's get that.
Exactly,
so that's probably, we economists, if we talk about costs, we don't mean just the dollars you're spending, right? We mean also the risks you maybe have when reproducing it. So we would say, yes, these are my costs, but in that process, I'm never sure whether the use cost would be enough. So you have kind of like a risk parameter in that, and that would be your real cost actually. Plus, you may have a timing advantage, right? So and the more you have of elements of value, then the more you may move away from the cost approach, because just because you can reproduce it may mean you're missing out on an opportunity to enter a market. So if this, even if it's a simple asset to reproduce, if it gives you like a huge first mover advantage, then you would usually say a reproduction cost is not that, it doesn't reflect the real value you can obtain with that just being the first mover. So I think that those elements play really a role, that we need to have like a hypothesis. What's the value? Is it something of high value or something I can reproduce at any point in time, and therefore decide, is a cost approach appropriate, or do we need to use a different approach?
Thank you, Kerim.
And
I need to step.
Rutger,
Rutger, can you please let me moderate? We have allocated a certain time, and we need to keep moving on to be able to cover all the topics. We will have a separate session on valuation methods, like I mentioned in the beginning, and there we can go into details. Otherwise, we cannot, cover the whole presentation. Thanks for your question. Back to you, Sebastian and Kerim. Please continue with your presentation.
Thank you, Rezan. But let's be clear here. I really like that there's so much discussion already going on, and it shows the very views we have and interesting views and questions. So thanks again for that. But indeed, keeping an eye on the time, we have a lot of topics to cover, and let's see how far we got. Svetlana, can you show me the next slide, please? Thanks. So what I will do, and also again in the interest of time, is then very briefly, high level, show you the different income-based but traditional IP valuation methods that I've shown here. I think again it's important to mention them at least before Kerim will discuss the specific when it comes to transfer pricing considerations. I've listed the four, well, I would say, most well-known income approach for IP valuation. Obviously, there are many others, but they're much focused on the same principle of discounting future cash flow at a risk-adjusted return. You see the methods here referred to as the relief from royalty method, the multi-period excess earnings method, the incremental cash flow method, and the residual profit split method. And again, I will briefly discuss them, and apologies in advance if it goes a bit fast, but like it's mentioned before, we will have a follow-up session with a lot more time to discuss them in more detail. So I think the relief from royalty methods is maybe pretty well known and also very popular. I've experienced with practitioners. I believe part of the reason is because that the methodology behind it is relatively straightforward. It quantifies the value of an asset by estimating the hypothetical royalty payment for the use of an asset. So the value of the intangible asset can be obtained by determining the capitalized amounts of royalties that would be payable by the owner if the asset was licensed from a third party, rather than just owning the asset itself. So we're dealing actually with the concept of cost savings to come up with the value of the subject intangible. In other words, it calculates the present value of cost savings created by owning the assets, rather than not having to pay a royalty to a third-party licensor. It is, for that reason, typically you apply it for assets that can be licensed, to put it simply, so trademark, patents, software brands, and databases. And the starting point, as you see in the formula, is basically take into account the revenues and apply a certain royalty rate. And that sounds a bit easier than it is, because especially the transfer pricing practitioners in the audience would know, come up with a suitable and applicable royalty rate is a challenge and an analysis in itself, I would say. You would then look at databases, market data to come up with a suitable rate, but that has to be assessed on what royalty base you would use. Would it be on turnover or profit? Is the rate that you come up with comparable if you do like a real CUP analysis? So there are practical challenges in coming up with that royalty rate. Once the royalty rate has been determined and you apply it to the allocated income, the idea is that the royalty stream is then the after-tax royalty stream is then discounted to the present value of the remaining useful life of the asset at a risk-adjusted discount rate. So pretty straightforward in its approach, but what you see, and that is also getting back to one of the earlier questions that Rutger proposed, this method is also often used in connection with other methods. For example, the incremental cash flow method, and if there's time, I will show you that in a minute. On the right, we have the multi-period excess earnings method. It's based on the premise that assets generally only generate cash flows together with other assets. So it assumes that a company has maybe one or two so-called leading assets, and that other non-leading or contributory assets are leased externally against a fictitious expense. And that way, it tries the method to isolate a portion of cash flow that can directly be associated with the subject asset. So given the nature of this method, you can imagine this is, for example, suitable when you're dealing with customer-related intangibles, such as customer relationships or order backlog. But it also can be used for developed technologies. The idea here is, again, you take, and that is, I think, the common denominator with all methods aside the relief from royalty method, that they take a rather holistic approach, looking at the earnings from a company and try to carve out certain elements or remunerate certain elements to isolate the earnings, the cash flows that can be attributable to the intangible asset. In this case, the mechanism used for the multi-period excess earnings methods is using so-called contributory asset charges. And that way trying to remunerate the assets by a suitable required of return for those assets, and that are typically PPE related assets or working capital assets, and then carve out the remuneration for those assets. And what you would then have left below your income statement, let's put it like that, would then represent the value, the earnings that are connected to the intangible asset under review. It's a bit of, I would say, accounting-based methods. Also, the concept of the weighted average return on assets comes into play. So rather than a discount rate for a company, you would come up with a return for all the individual assets that are being taken into account as a contributory asset charge, and then come up with your final value. The incremental cash flow method is another very helpful and convenient way to isolate the value of an intangible asset. And the idea is pretty basic. It's also referred as the with or without method, because you're actually doing a valuation analysis for the whole company, so to say. So you see in the formula not only royalty as was the place for relief for royalty method or contributory asset charges for the multi-period excess earnings method, but you see deductions for capital expenditure, working capital, so more like a classical, I would say, DCF valuation analysis. But you would compare two scenarios, one in which the company or the enterprise owns the asset, and the other one not owning the asset. So the idea behind it is that the difference, the discounted value, obviously, of that difference would then reflect the incremental cash flow, so the value of that intangible asset. This method can be seen, for example, for non-competition and employment agreements, licensing agreements, and supply agreements. And as I referred earlier, a nice way to perform a sanity check on this method is actually to do a, let's say, simplified relief for royalty approach, in which you would, like double check which implicit royalty rate has been used to come up with your cash flows. So, like in the simple approach, you could use, for example, Excel's goal seek function and look what is actually the implicit royalty that has been used in performing the incremental cash flow method, and you see or benchmark it against market rates. And then finally, and again, I keep it a bit high level in the interest of time, I listed the residual profit split method. In a certain way, it's maybe not a traditional IP valuation method because it's more often used in the transfer pricing setting, obviously, and less commonly used in, for example, PPA analysis. At least that's my experience. So I will not spend too much wording on that, but I think the basic idea is pretty well known to the audience. You take into account your total cash flows, you make a certain deductions, in which an important one are the transfer pricing arrangements. So routine returns or other arrangements, such as cost sharing profits or management fees. And Again, basic principle in which you carve out certain aspects that have nothing to do with the intangible asset that you're trying to value, and your residual value, discounted value at a risk-adjusted discount rate would then reflect your the value of your intangible asset. That having said, and if there are no questions on the methodology, and once more I stress that we will spend much more time on the methodologies in the follow-up session, Kerim will take this one on for to address. No, I'm sorry, there's one more slide. Svetlana, can you show that one? Because for these methods, and that I think is a nice bridge for Kerim to touch upon the specific transfer pricing issues, I listed a few issues, more like general issues when it comes to IP valuation. And I think there are much more than are listed here. But for example, one of them is already a very important one, also looking at important case law when it comes to valuations, is the assessments of the useful life. So trying to assess the length of economic benefits that are produced by the intangible asset on the review. And it can be very uncertain to determine the useful life because it's also heavily affected by external factors. For example, the nature and duration of legal protection, or the rate of technology change in the market, or changing competition. So it is a difficult analysis, and you see also a lot of different views on it, whether we can have a limited remaining useful life, RUL, or take into account, and I think that is a bit of aggressive take in many cases, indefinite life, in which you would apply a so-called terminal value as an add-on to your value of your projected cash flows. I think to give an example, to give the complexity when assessing the useful life or of the intangible asset, you can take, for example, a customer relationship in which you have to assess multiple elements, for example, contract terms, expected contract renewals, some legal and regulatory aspects, the product life cycle, for example, industry outlook, level of competition. So all those elements should play a part when you would assess and come up with your useful life. And needless to say, your useful life, and especially when you take into account the terminal value, can have a huge impact on your valuation outcome. I listed very briefly also the concept of attrition rates, maybe to briefly touch upon that. That when you perform a valuation analysis, you have to ensure that upon ending of the determined useful life period, there will be no revenues left from, in this case, existing customers that exist on valuation date. So typically what you then see is apply a certain rate that reflects that at the end of your useful life period, there are no revenues from existing customers. Another element here, and that speaks a bit for itself, is planning data, your forecasting data. Projected cash flow can obviously be very volatile. Personally, I really like to do a form of cash flow sensitivity analysis to back up your projections, and also to have like an interesting discussion with management, for example, whether to challenge them on, for example, management projections. But also keep in mind on this part, so I try to give a few red flags or practical implications, that when you are presented with planning data, what is the source and purpose of the data that has been provided? So if it are financial projections provided by management, it may include certain buyer-specific synergies, for example, that in certain instances would be disregarded for valuation purpose, but market participant synergies would then typically be included. So that also touches upon a topic we are going to discuss later on.
Sebastian, maybe a question on the useful life. So when we ask usually for projections from the client, depending on what we ask, they may send like 5 years or 10 years, and assume that you have 10 years information. And of course, if you use 10 years as a basis, and then the asset has an infinite life, you need to calculate terminal value at the end of 10 years, which will give you a different value if you would give useful life of 5 years. What drives the decision specifically?
A good question, and I take the opportunity also to answer that question, referring to well-known cases when it comes to transfer pricing valuation, being the Amazon case and the Veritas software case. Because in that case, and that's the reason I'm referring to those cases, there was a big difference, as many people probably know, between the valuation prepared by the taxpayer and the valuation in both cases prepared by the IRS. And I think there are multiple elements I can highlight, but one important one was the views on the useful life. In both cases, the court, simply put, ignored or disregarded the view from the tax authorities, in which they took the position that the asset had an indefinite useful life, given the nature of the assets. And I think that is more often the case than not, that the intangibles that you are trying to value have a lifetime that is not going on indefinitely. I think also when you take into account the arm's length principle, it's hard to make an argument in many cases that a third party would pay royalties or buy-in payments for an indefinite period of time. So that is more like, in general, that I think it's very difficult to make an argument for intangibles. And obviously there are some typical examples for bigger brands and stuff like that to say there is an indefinite lifetime and therefore we apply a terminal value. But getting more concrete on your question, Rezan, using the parameters or the main characteristics of the intangible asset that you're trying to review, and I mentioned contract terms, renewals, product lifecycle, on that basis, you should assess the length of the useful life. And it can also easily be shown in documentation from a patent or the contract that can be renewed. But in many cases, they will be much shorter. And getting back again to the Veritas and Amazon case, on the top of my head, I think the taxpayer was given, the court agreed with the taxpayer's view that it was only at a life cycle of 4 to 7 years, something like that. So that is, I think, more typical when dealing with intangible assets. To wrap up, and then I will give the floor to Kerim for the transfer pricing assets. I listed discount rates. I already mentioned the WARA, so the weighted average return on asset analysis, as part of the multi-period excess earnings method. The WACC to WARA analysis is a nice way to double check your discount rates, which is often the WACC, but let me emphasize here that it is not necessarily the WACC. The weighted average cost of capital can also be a different discount rate. And by theory and in principle, the WACC and the WARA should be equal, right? So if you would determine the cost of equity and cost of debt of a company and come up with your weighted average cost of capital, that in principle should be equal to the weighted average return of all assets on your balance sheet. So that is a nice way to double check whether your discount rate makes any sense from a more accounting-based point of view. There are also like some practical or solutions or methodologies you could use. Personally, I'm a big fan of using a more what I call a dynamic WACC or discount rate versus a static WACC. So if it's dealing with, for example, the incremental cash flow method and you are valuing the company as a whole, initially start to align your WACC with the company structure, your financing structure as it is. And then over the course of your projection period, work towards, for example, the target capital structure or market structure. So you have actually a different discount rate for all the individual years in your projection. And that is also a big factor if you would apply a terminal value to your valuation analysis. And then in the later session, we will discuss the nitty gritty, how to come up with a discount rate. So using the CAPM or Milde model, approaches on determining the beta and risk-free rates and stuff like that. But I think fair to say, and also nicely shown in the two valuation cases that I just highlighted, that can be very different views on risk and the discount rate, and having a tremendous impact on the valuation. Amazon, I think it was, of Veritas was discount rate of 20% versus 13% by the taxpayer. So that already immediately shows an enormous impact on your valuation. Taxes, I leave it for here because I think, Kerim, you will also spend a few words on the implication of taxes. Maybe only...
There's one question, Sebastian, before you hand it over to Kerim from the audience. I think I kind of guess the answer right anyway, but it might be good to confirm it by you guys as well. And I agree with you that useful life, and I think discount factor, if it's fair to say that those are the most important ones that drive the value. The question is more specifically about useful life, and it refers to basically software such as Windows or SAP. And our audience is saying that, well, whether it makes sense to basically set a useful time period rather than saying it is perpetual. It's technology, but let me hear what you think.
Yeah. You want to kick off, Kerim, maybe, so we can
Yeah,
divide
why
our
not?
time? Yeah.
So,
yeah.
so I think that we can cover this question also by touching on the differences maybe to like standard valuation approach, and we quite often get the question about what about the PPA value? What's the difference? And this could be actually
Right,
one
yeah.
as well. So when we talk about the useful life, I think there is the assumption of whether you look at only the value of the IP you have at that point in time, right? So when you do the PPA or you transfer, I think, and Sebastian, you correct me, that's kind of like from a financial reporting perspective, that definition. For transfer pricing perspective, we actually say, is there a platform value also inclusive, right? So, and if that's the case, then we can of course have a longer horizon, sometimes even a terminal value if there is a platform value that will really be that significant. So I won't say really the answer for Microsoft because it depends on how you define that asset, but if it's really something that creates a platform, you can have a longer one. It has to be very, very significant to have even a terminal value if you talk just about a specific IP. But if you have a broader restructuring and everything is lumped up to them, and we're talking about a business altogether, then likely you're going to have a terminal value.
Yeah, agree. Yeah.
And maybe we'll take that chance to also say, well, what other differences do we see? So if you have a purchase price allocation where you have an acquisition price, you're broken it down by your valuation approach with Sebastian, right? And you have different assets. Can we take them or not? Sometimes we can, but differences maybe if you have the purpose for the PPA was maybe on a consolidated level, then usually the PPA doesn't break it down which entity owns which IP, right? The other assumption in a PPA is usually that the transfer pricing model of the acquired entity is actually arm's length. So there is, which may be true, may not be true. And therefore not considering if there is a problem of the allocation of income, etc., then the purchase price allocation results may be not in accordance for TP purposes. And if you have certain input variables into the PPA analysis, which are intercompany, like a royalty rate, then the question is that an arm's length royalty rate that falls rightly into the PPA analysis and then derives also the arm's length result? So there are a few elements of it, but assuming we are only talking about an asset, not a whole business, not a profit potential, we are very close, right? But we need to consider a few adjustments to make that actually work for transfer pricing purposes. Sebastian, is that all right? I will jump to the next slide.
Yes, absolutely. Maybe one final comment on the IP issue on the previous slide. I keep it very short, but I think it's very relevant for this topic. In the taxes, and as you can imagine, there are many implications of taxes to be considered when you're dealing with a valuation analysis, let alone an IP valuation analysis, on which basis and gross ups and the impact on future cash flows. I listed the inclusion of a tax amortization benefit as one of the implications of a transfer. So the buyer in that case would maybe include a tax amortization benefit in the valuation analysis, and the seller of the intangible would be faced with an extra charge that we going to discuss in a minute. But just the concept, and then I give we move on. The tax amortization benefit of the TAB, it reflects the present value of hypothetical tax savings related to the amortization of the intangible assets over its useful life. So it has to be linked to the useful lives, obviously. And the ability to amortize the assets can be considered part of the tax shield. And as the valuation analysts in the audience may know, tax shields also have a present value, a value to be added to your value. So it is an add-on to the value, and you can see it in the cost approach. You can see it in the income approach for all the different methods. You see basically when you calculate it, going through your financial statement and determining your discounted free cash flows, As a final step, an add-on using, for example, a tab factor, the tax amortization benefit. So I think it's an important one to mention briefly, but let's move on.
Just to remind us that we have about 17 minutes left. I know you have
Yep.
some great slides left, so go on, please.
Svetlana, if you go to slide 11, if you don't mind. So let's dive in. So we talked about general valuation approaches, and they are technically as relevant for transfer pricing as for non-transfer pricing cases, right? But what makes it sometimes difficult to just use the standard approaches without the TP model instead? And we talked about briefly the differences between, are we talking about a valuation of a single asset or a group of asset which is homogeneous, or are we talking here in like a chapter 9 context of a business restructuring where we're actually dealing about a whole new transfer pricing model, and therefore we're transferring likely more than just a discrete IP, but transferring other business opportunities and what we call here generally profit potential. So here, to make it a bit more kind of like transparent here, we've highlighted example 1 and example 2. So let's assume we have an example 1, a US and a Dutch entity. And usually the Dutch entity has IP, is manufacturing, is distributing. And then an IP sale occurs where the Dutch entity sells the IP to the parent co in the US. And after that, basically licenses the IP back and operates pretty much the same way as before, just is not the IP owner anymore. In example 2, we have the same starting point, but after the IP sale, the Dutch entity actually is not servicing directly the market. It obviously doesn't have IP anymore, but it becomes a toll manufacturer for that US parent. So here, I guess you can immediately see the IP sale is only the triggering event. And the question will be, is it just an IP sale? Can we narrow it down? And we probably are closer to the traditional valuation methods, could likely work with a relief of royalty approach. Or are we in that right bucket where we say, look, you have changed so much. It's an IP sale, but at the same time, the customers are gone. I'm not servicing the clients, the customers myself anymore. I'm not booking that revenue, and I become a service provider. So here, instead of looking at everything in separation that happened as a sequence of events, in example 2, we have generally the approach to bundle that and analyze what value has actually being transferred from the Netherlands to the US. And that's what we call the transfer price. So likely on the left-hand side, a standard valuation approach, but of course you will have not on this one a lot of information to make full conclusive statements, because you don't know what parent company is doing with that IP. They may be licensing it out to regions you have not been involved. So the options realistically available, again, for the Dutch entity would play a role to say, what inputs do go into my analysis, what profit potential has left. And we don't need to result in totally different numbers than having a traditional analysis, but all the implications from a transfer pricing perspective will play a role. We can jump to the next slide. And here, one example of where do we actually see IP valuations being quite often necessary, right? Relatively often, it will be post-acquisition. That's why we always have the issue about, do we have a PPA? Is the PPA sufficiently enough or not? But don't forget, we also have an acquisition, right? So that's quite often the case where we have an acquisition and a post-acquisition merger integration process. And here, as an example, I picked again a US entity, which is the buyer entity, and the target entity here, I picked Australia. And we assume the US entity acquired the group headquartered in Australia for 1 billion. And then they do a lot of restructurings that follow the acquisition and leads to a result that the target parent in Australia becomes rather a routine entity. So a classical example of, I buy all the IP out, but at the same time, I'm basically turning the target parent and the subsidiaries to a routine entity. So a quite common observed method, and I'm not gonna, because we'll keep it open, this is maybe food for thought, quite often observed method where tax authorities push us in that direction often as well is, why don't we look at the acquisition price and see whether that gives us enough evidence to conclude of the value that's left Australia and moved to the US. And here, if you start with that 1 billion, very simple calculation would be, we'll take that 1 billion, we'll make a few adjustments for cash and liabilities and maybe there are other impacts. But let's assume there's nothing there. We'll stick with that 1 million. And we assume the remaining value of the Australian enterprise is 100 million. So basically 900 million of value is moving over. Now, that's not just IP, but that's everything of profit potential the Australian entity is losing. Quite often observed, but it's not as simple, and there are lots of question marks around this method, right? And first, we'll start with, is this acquisition price actually reflective of the acquired business, right? And here we have a few problems to deal with. First of all, one is easy to manage is, it's not just one entity, it's a group. So that value needs to be broken down based on arm's length transfer pricing model of what value should be with that parent entity that holds here, in this case, the IP, versus the other entity. So there's already one layer of value that doesn't belong even to the Australian parent entity, which one needs to carve out. The problem with such analysis is, well, if there are already subsidiaries in place, you of course have an anchor. You see these entities, you can have projections and growth rates, and then therefore allocate some value of that 1 billion to these subsidiaries, which let's assume they're of routine nature, but still of value reduces the 1 billion as a starting analysis to determine what IP value and profit potential has left Australia. But what if you don't have any subsidiaries already? What if this is an earlier stage? They would probably enter into such structures. To lift that 1 billion of value, these entities need to have subsidiaries abroad. Probably they have like a research facility somewhere, they need distribution facility somewhere, but there's nothing in place. So do we impose that? Do we say, well, realistically, there should have been one, and therefore you should need to pay something to those entities, or can we still stick with that 1 billion starting point, right? So that's one big chunk of analysis. And the other one, which is very controversial, is that 1 billion even reflective of the value of that business? Because you're paying a very high premium usually when you're buying an entity, when you're buying a whole group. Lots of evidence we have around that time, so about the topic, but do we allocate that value really as a starting point from this acquisition price to determine what IP value has left? Can we rely on the PPA? Usually we can rely on the forecasts you've used in a PPA, because they are at least forecasts used by the company, and it's good to be there consistent, but they've usually come up with very high growth rates. So there would be careful consideration. If you do that, you probably have then to say, well, the discount rates should also be the appropriate ones coming out of the PPA, which is the internal rate of return you have in a PPA, tying back the acquisition price to the projections you've used. If you use different ones, you're basically already creating a problem in your analysis. Then there is the notion of, since we're looking at companies we know, we need to take their circumstances in consideration and also tax. So do you need to talk about, well, are there carry forward losses and an exit payment has a certain impact to that payment, or the exit payment will be taxed fully, and therefore do I actually need to gross up my amount to be even again when starting with the acquisition price in my analysis? And also, is there a time gap, right? If you have a time gap between your acquisition point in time and when you're transferring an IP. So those elements will play a role, but I think the major one, the most controversial, is the acquisition price in itself, the right starting point to assume this is the value for that entity, but as I said, quite often observed in the market and also by tax authorities.
Kerim, perhaps not directly a valuation related question, but the topic of goodwill, I guess, is an important one, because of the taxation impact. If you can, maybe in a half a minute, 30 seconds, this kind of projects?
Yeah. So, okay, I'll take 20 seconds on that. So the goodwill is usually a result, right? You have in this context an acquisition price. We'll do a purchase price allocation. We can allocate some value directly to some assets, but there will be a remaining value, and that's going to be the goodwill proportion. Now, here we are doing a slightly different analysis. We're starting with the acquisition price, or maybe even if we do a totally different, but we'll start our analysis separately. We'll come up with the value. Now, the question still will be, if you actually need to book this in your accounts for accounting and tax purposes, is, how do we call this? If it's not just a single IP, but a broader restructuring, then there's likely going to be some goodwill value in that, which needs to be determined by, again, using regular valuation methods to carve out the discrete IP. And the remaining is goodwill, and the tax implications depend on the country residency. I mean, I'm not a tax lawyer, but usually it will depend on the buying entity, how they treat goodwill. Can you actually get deductibility for tax purposes on goodwill or not? Will depend on some. In Germany, we do, right? We have the 15 years period where we can also get deductibility for goodwill, but in other countries that's different. So it will depend on that case. Does that answer your question, Rezan?
Yeah, perfect. Thanks.
So this is in the context of an acquisition price. I'm just going to highlight that if you have an acquisition price, even if you don't believe this is the right method to do and you default to another one, there is some sort of need to reconcile back, because naturally, if you're facing an audit and you have this amount floating around, then the question is, what is it, right? Why is it, or why is it not indicative for the business value? And it would be odd. Let's assume you buy an entity for 1 billion. A week later, you're transferring IP and turning this into a service provider, and the net present value of that remaining company is almost zero, right? So no surprise, question will be asked then. So let's move to the next slide, if you don't mind, Svetlana. I'll try to cover.
Maybe only, Kerim, to add on that,
Sure.
on that final note, I think we agree that although that it's very true, and most likely you would need to link your acquisition price with the methodology you come up with, there are actually arguments to be made that certain elements of that premium are related to a whole other data, like control premiums or shareholder value or synergy. So it is basically, I think, an analysis of the nature and the source of the premium. And then, in my view at least, there are arguments to be made that there is a significant lower value. Yeah,
Sebastian, I mean, those are the arguments. I'm not going to conclude on this, to be honest, because I can see both positions. But I don't think that discussion has been resolved, in my opinion.
Okay.
So there is some missing piece in the practice and academia. But yeah, those positions are taken. Yeah, I agree with you, Sebastian. So let's assume you don't have an acquisition price, and we're still talking about a broader restructuring event. What do we do there? And we have opening statements or guidance in the OECD that says, well, in this case, we need to basically look what are the realistically available options for both parties, right? And here it's very hypothetical sometimes, right? Because you're not exploring all alternatives if you're in a group environment, so you may not have all the information. But that's basically what is asked. And some countries are more specific on that. Germany is one example. The Netherlands have now some rules that go very deep into that discussion, is looking at the seller and the buyer separately and see if you have a bigger restructuring event, what does happen to your expected earnings from a net present value perspective. So you discount that pre and post restructuring. And by post restructuring is basically your transfer pricing model that happens after you move IP and change everything. And the post will be a hypothetical scenario. What is the alternative? If I don't sell the IP and don't restructure, if I stay the same in my organization, what would be actually my profit potential? And from a seller's perspective, if you do this, you'll basically get the difference of these two scenarios and say, well, if there's a gap, that's the minimum price I will see, assuming that your profit potential will drop after the restructuring. Then you'll have your minimum price. And from a buyer's perspective, and here comes the discussion about synergies, what's your benefit when you do this transaction, and what's your profit potential after you've moved the IP with all the subsequent restructuring events. And then you will have the buyer's most or highest amount available, his willingness to pay. And here in this example, we picked 10 million as the minimum and 50 million as the maximum. And the idea would be they meet somewhere in that spectrum of room for negotiation. Some big issues before we need to wrap up here is basically, well, what are the hypothetical scenarios, right? That's a very big unknown. That's very subjective quite often. So it sounds very simple from a legislative perspective for tax authorities to ask this question, but quite often you really don't have this information. You need to look for different discount rates because your functional profile will change. So after restructuring, quite often companies become rather routine. So they will be using a different discount rate for that. And then the question is of tax. What do? Do you consider a tax gross up to make you even? From a seller's perspective, you need to think about considering a tax amortization benefit from a buyer's perspective that also increase your willingness to pay. And a big issue will be in an organization where you have a sale of IP, but that is more like for operational reasons, for other reasons than really saying this is to lift some synergies. You quite often will have the same set of financials. You're moving IP, you have one projections. You're not hypothesizing what synergies will be left if I don't do it, and maybe there are really no differences. And if you have that scenario, you're likely not going to have a clearing price, because from a seller's perspective, there's always the tax implication that will cause that the amount will be grossed up. And from a buyer's perspective, you will have a tap which is smaller, but if you work with the same set of projections, you will likely gonna have the tax differential that might drive the difference, but quite often we don't have a clearing price. And the assumption is then, well, who takes that, right? Is it really just a shareholder decision to move that? Maybe that's an answer. Some countries say, well, then we'll split that loss more or less and still meet in the middle. But quite often it's the question, are the projections are actually correct? Like, are we missing here a piece of the puzzle that the buyer will have additional benefits which are not shown in the projections yet? I think
Kerim, just
yeah, but you go ahead.
Yeah, we are indeed at the end of our time. We have one question about option realistically available, and I leave it to you to decide whether you want to address that. Basically, the question is whether this analysis should take into account internal options realistically available, but also the external ones. And one question I have, and if you both of you could give this half a minute again, what would be your main recommendations, basically for our audience who are dealing with valuations of intangibles to reduce any chance of disputes with tax authorities they are dealing with? So first, the first question, and then the second question, please, half a minute so that we can close nearly on time.
Sure. So the first one, and I'm not sure that this is an opinion only, but the question of realistic options available is, for me, answering the question, it has to be a realistic option. So outside options would be, if they're realistic, that you could say, instead of changing my organization and selling my IP, what would be if I license it to someone else, for example, right? That, in my opinion, that would be something to consider. But usually the default, and here we have to be probably practical, the default in this kind of analysis is, what if I don't do anything? What if I keep the IP and operate the way I do? That's usually the best anchor point. But as you can see, you are quite free in hypothesizing scenarios you believe are realistically available options. The other question is, so from everything I'm seeing, there are lots of companies who even ignore this, right? They do a restructuring event, and just because they don't have an IP in their accounts, they basically ignore it, right? You have a restructuring event, and years later they realize, oh, maybe there is actually an IP that we have not ever recognized for accounting purposes, but since we've changed it, that IP is gone. So as soon as you're already thinking about it, that's the biggest hurdle. So that's my first recommendation, right? Don't, if you change anything, if you have your TP model, with any impact on profitability, the question will be, is there a restructuring event? Is there IP somehow involved from a TP perspective? The second one is, I would say, get a good understanding of what IP you're actually transferring. Is it really a discrete IP, or is it a broader business restructuring? And so that's quite often the definition are not that, or that conclusion is not that clear, and that results in very, very different numbers, and therefore it's kind of like almost doesn't matter what you do in the calculation then if your starting point is already wrong. So that would be one of the most important items. And maybe to the first question we received here is different. Ideally, those methods, if they applied appropriately to the right fact pattern, you have different methods, but not every method is for every fact pattern. But for example, the two-sided analysis, acquisition price, they are from a content perspective trying to do the same thing. So if you have resources, then it would of course be good to have that at least as a cooperative analysis, right? What I'm not doing usually recommending is to do another method which is not really applicable from an economic perspective. Well, then that's not really helping. That just by coincidence, that will land with the same result. But have your story right, understand really what IP is moving, what implication that has, pick a method, maybe a second, and also be always mindful we're doing this for tax purposes, right? We're not creating a new market price usually. In a TP context, we got to be mindful about the level of time and work you're spending here based on the risk you're taking.
Thank you. Sebastian, would you like to add anything to that?
No, I think Kerim touched upon most of it. Maybe just like a general recommendation, but that highly depends on the country you're dealing with and also the tax authorities. For example, in the Netherlands, it's very convenient to upfront discuss these kind of topics, especially these kind of topics with the tax inspector, and see where you are aligned on the methodology. And like I said, as a teaser for maybe a follow-up session, I briefly mentioned the concept of real options. In the Netherlands, for example, you see a lot of more registered evaluators at the tax authorities who are open to discuss such methodology. So my personal recommendation, if it's possible, proactively reach out and just test the water with the authorities on your approach, because there are so many views as you have seen in this discussion.
Well, thank you very much, both. Really appreciate your views. This has been, for myself personally, very insightful, and I hope for the audience as well. We will have follow-up sessions. Before I close, I would like to turn to my colleagues, Rutger and Svetlana, if they want to say any closing words. Svetlana, Rutger, anything you would like to add here? Otherwise, feel
not
free
for
to...
me.
Thank you so much for being
thanks to the speakers
here. Yeah. Yes, and that was indeed very insightful, and for the audience to join in also today. Thank you so much.
And maybe a last word on the next webinar. We'll have two excellent speakers there, one from the United States, and Svetlana, you can add, because you invited her, have a little bit more of background on her.
Right, so the next session will be in June. You will have also a follow-up email about that. There will be Michael McDonald from the US and Marta Panke from Austria. Marta also head of tax in one software company, and Michael McDonald is a partner at one of Big Four. So they will share the insights on the role of DEMPE and the allocation of profits and all the problems that are faced also in practice, but also from an academic standpoint with DEMPE, and potential developments that are needed for the framework. So stay with us, and I'm sure this next session will be also very insightful. And thank you so much again for being today for this session.
Thanks.
Thank you very much.
Bye. Thank you all. Bye.